Hi, I'm James. Welcome to Sketching Finance, where we simplify finance through visual storytelling. Welcome back to day 6 of our 90-day financial transformation. Yesterday, we finished constructing your armor, the emergency fund. You are now officially protected from life's unexpected arrows, ensuring your survival. But as any seasoned warrior knows, armor alone doesn't win wars. To achieve financial freedom, you must eventually leave the fortress and go on the offensive. Now, it's time to choose your weapons to go into battle. This is the stage of asset allocation. However, here is the critical lesson. Not every weapon fits every soldier. Some warriors prefer a heavy shield for absolute safety, while others want a sharp spear for a fast, calculated attack. If you pick a weapon too heavy for your soul, you will feel overwhelmed, exhausted, and likely quit the journey halfway through when the market starts shaking. Understanding who you are is vital. Are you a defensive guardian or an aggressive conqueror? Today, we identify your true investment DNA so you can build an army that matches your spirit, ensuring you stay in the game until the final victory. Risk tolerance isn't just about bravery or being tough. In professional wealth management, it is the scientific fusion of two distinct elements: your risk capacity and your risk appetite. Most people confuse the two, but separating them is the key to a bulletproof strategy. Risk capacity is your wallet. It is a cold, mathematical reality. How much money can you actually afford to lose without it affecting your ability to pay rent, buy food, or sustain your life? This is objective. It depends on your age, your stable income, and your current assets. A 25-year-old with no kids has a high capacity. A 60-year-old near retirement has a low capacity. Risk appetite, on the other hand, is your heart. This is purely psychological. How much market volatility can you stomach before you lose sleep? This is subjective and depends on your personality and past experiences. Even if your wallet is full, your heart might be fragile. We use the sleep test to measure this. If your portfolio drops 20% in value in a single week and you still sleep like a baby, you are an aggressive warrior. But if that same drop makes you stay awake at night, checking your phone every 10 minutes in a panic, you are a conservative guardian by nature. You must balance the wallet and the heart to succeed. In the world of wealth, every investor belongs to one of 3 main tribes. Let's identify your tribe so you can allocate your resources correctly. The conservative investor focuses on protecting what they have. Your primary goal is to beat inflation slightly while avoiding any large red numbers. You are the guardian of your capital. You prefer safe havens like gold, savings accounts, and government bonds. You invest for the short term, usually 1 to 3 years, and your heart hates volatility. The moderate investor seeks a balance. You want steady growth over the medium to long term, usually 3 to 7 years. You understand that waves are part of the ocean, but you prefer a smoother ride. Your army is built of blue-chip stocks and index funds, providing a solid mix of defense and attack. The aggressive investor is a hunter. You accept big swings in exchange for the chance to maximize returns. You don't fear a market crash. You celebrate it as a big sale to buy more growth stocks, crypto, or startups. You are playing the long game, looking 10 or 20 years into the future. Age is the primary factor in your mathematical risk capacity because time is your greatest ally. The classic formula is the 100 minus age rule. If you are 30 years old, the rule suggests putting 70% of your assets into growth channels like stocks, while keeping 30% in safe bonds. This is because at 30, you have decades to redo and recover from any market downturns. However, we live in a new era. With longer life expectancies and higher inflation, many U.S. experts now suggest the 120 minus age rule instead. If you are 30 today, that means 90% in stocks. Why? Because you might live for another 60 years. If you are too conservative, inflation will slowly destroy your purchasing power over those decades. Even at age 60, you may still need 60% in stocks to keep your portfolio's growth engine alive. But what if your wallet says you can take risk, but your heart is terrified? This is the tech pro dilemma. If you have a high income but are traumatized by past crashes, use the 50-50 anchor. Start with half in stocks and half in bonds to limit your downside. Every 6 months that you don't panic, move 10% more from bonds into stocks. This builds your risk muscle gradually until you reach your target. Now, let's explore a concept used by top-tier financial advisors: human capital. Your job is not just a source of income, it is actually a massive asset in your total portfolio. How you earn your active income determines how you should invest your passive income. Meet Sarah, a government nurse. Her income is incredibly stable, protected by civil service rules and a guaranteed pension. Financially, her career acts like a bond, a steady, low-risk cash flow. Even if the stock market drops 50%, Sarah still gets her paycheck on the 1st and the 15th. Now meet Mark, a tech engineer in Silicon Valley. His salary is high, but it's volatile. He relies on bonuses and company stock options. His career acts like a stock. It has high growth potential, but is prone to sudden layoffs during economic cycles. Because Sarah's human bond is so strong, she can afford to be much more aggressive with her financial capital, aiming for 90% in stocks. But Mark is in a dangerous position called positive correlation. If the tech sector crashes, he might lose his job and his investments simultaneously. Therefore, Mark must be more conservative, aiming for only 60% in stocks to balance his risky career. We use the beta of your career to fine-tune your allocation. A stable job like a doctor or teacher allows you to add 15% more to your stock ratio. A volatile job like real estate sales or trading means you should subtract 15% from stocks and keep more cash to survive the long droughts. A nurse like Sarah can even work overtime during a recession to buy more stocks when prices are at a sale price. Your true risk capacity isn't just your age, it's your ability to create new income when the market collapses. Many people fear the risk of losing money, but they forget the risk of being too safe. In U.S. finance, we call this shortfall risk, the risk that you won't have enough to live on because you are too scared to grow your wealth. Meet Safe Scott and Growth Grace, both 30 years old with $100,000. Scott fears market drops, so he stays in bonds and cash at 4% interest. Grace understands history and invests in the S&P 500, averaging 10%. 30 years later, at age 60, look at the difference. Scott's conservative path resulted in $324,340. But Grace's aggressive path grew to over $1.7 million. Being safe cost Scott over $1.4 million in lost growth. With $1.7 million, Grace can retire comfortably, withdrawing $70,000 a year forever. Scott can only withdraw $13,000 and must likely work at a supermarket to survive. In the short term, stocks are riskier than cash. But in the long term, cash is the riskiest asset because inflation is a 100% guaranteed fief of your purchasing power. Short-term volatility is simply the parking fee you pay for the privilege of long-term wealth. Percentages feel like a math grade, but dollars feel like life. To ensure you don't react with fear-based instinct, you need a fire drill. Imagine a $500,000 portfolio. A standard 10% dip means you just lost $50,000. That's a base model Tesla gone in a week. A 20% bear market means you lost $100,000, the down payment for a suburban house. Can you look at that negative 6-figure number and still go out for a peaceful dinner? If not, your allocation is too aggressive. This is why professional advisors use an IPS, your financial constitution. It is a written contract signed when you are calm, to be read when you are panicked. It prevents you from selling at the bottom. An IPS forces you to rebalance. When the market crashes, you don't panic. You follow your contract. You move money from your safe bond bucket into your stock bucket to buy at the discount price. Without rebalancing, your portfolio will evolve into a monster. After a bull market, your stocks might grow from 80% to 90% of your total wealth. You are now taking much more risk than you planned, right before the next inevitable crash. Use the 5-25 rule, favored by experts at Vanguard. If an asset class moves more than 5% from its target, fix it immediately. This forces you to buy low and sell high through cold discipline, not emotion. But the ultimate cure for your lizard brain is automation. Set up automatic contributions from your paycheck into a target date fund or a 3-fund portfolio. When you don't have to click the button to buy or sell, you remove the opportunity for your instincts to sabotage your wealth. Finally, recognize that risk tolerance is not static. It evolves with your life stages. Marriage is a financial merger that increases your capacity. But having a child creates a fixed liability of $300,000, usually shifting your appetite towards safety. Financial maturity means moving from "how do I get rich fast" at age 20 to "how do I never be poor again" at age 50. It is about knowing when to drop the spear and pick up the shield to protect your family's future. Today's homework: audit yourself. How old are you? Is your job a bond or a stock? And can you sleep while losing a Tesla on paper? You now know your weapons and your DNA. Tomorrow on day 7, we set your targets, SMART goals. We will calculate exactly how much you need to retire. Subscribe now, and I'll see you there.